The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. The global markets are navigating a stormy mix of uncertainty driven by U.S. President Donald Trump and his slew of tariff threats. With sentiment shifting on a dime and developments keeping investors on edge, the short-term outlook for risk assets remains anything but clear-cut. So as the world watches closely to see how the 90-day pause on reciprocal tariffs play out, alongside the looming threat of new sectoral tariffs, the stakes for markets and the broader economy are high. So what's ahead, and how should investors position themselves? Well, to find out more, joining me now is Vasu Menon, who is the Managing Director of Investment Strategy at OCBC. Vasu, thank you so much for joining me.
Thank you very much for having me on the show as well.
Well, Vasu, Trump's decision to pause reciprocal tariffs has provided temporary relief to markets. How much optimism should investors reasonably build into this pause, though? Was the initial relief short-lived?
Well, if you look at the way the markets performed post-Trump's pause, the MSCI World Index, which measures global equities, has rallied about 8% in the last 8 days or so. Right? And similarly for the S&P 500 index, it's also up about 8%. Now, that's no loose change. I mean, it's a pretty decent performance. But the big question is whether Trump will continue to pause his tariffs, whether he will negotiate with trading partners and come up with a solution ultimately that will bring the final tariff rates down significantly from what they were when he first announced it on the 2nd of April. So whether this is a relief rally or whether it's sustainable, I think it's open to debate. A lot hinges on what happens when, in early July, when the 90-day period ends, and then we get a better idea of, how the negotiations are planning out. Now, he says that, about 15 countries have come up with agreements. He seems quite excited about it. So let's see what happens with the news flows in the coming days and weeks. But if the indication from the initial agreements show that Trump is prepared to bring the tariff rates down significantly, then I think that is going to boost optimism. And this may not be a relief rally. You could see further upside.
All right. Well, there has been this pause, but what happens in the next few days is quite unpredictable, given that it is Donald Trump here that we're talking about.
That's right.
So, Vasu, what potential outcomes from the trade talks are markets currently pricing in, and how might those expectations shift in the lead up to July?
So as we talked about it just a couple of minutes ago, I think what the markets are pricing in, or rather what the markets are hoping for, is that the final tariff rates that are negotiated will be significantly below what they were when they were announced on the 2nd of April.
Right.
Now, Trump has set a baseline tariff of 10%. That's his universal tariff. That remains right now. Now, the markets are hoping that hopefully we'll see 10%, slightly more than 10% in terms of, tariffs for most countries around the world. Now, if it turns out that some of the key trading partners, especially the big ones, end up getting hit with significantly higher reciprocal tariffs, in other words, even after negotiation, they don't come down very much, that's going to spook the markets. But on the other hand, I think if they do come down significantly after the 90-day period, then I think it's possible the markets could actually find some relief and then hit higher. But at this juncture, I think the markets are pricing in a mid-level outcome where they are not expecting rates to go all the way down to zero. Neither are they expecting it to be as high as what Trump announced on the 2nd of April. Hopefully somewhere in between. Even lower than that would be a bonus.
Right. Well, while Trump's move on tariffs opens the door to de-escalation, that's not going to happen overnight, right, Vasu? So what should investors be doing during these days till the end of the pause? Should they be reallocating their portfolios?
Well, I think investors shouldn't get carried away. Investors shouldn't panic. I think what we see coming out from the rhetoric in the last 1 to 2 weeks has been mildly positive. Not just Trump pausing on his reciprocal tariffs. He's also offered a pause on smartphones, electronic products, mostly coming out of China. And then on top of that, he's talked about, pausing automobile tariffs once again. So, the feeling I get is that, Trump is veering towards a slightly softer stance. So investors should not panic. They should not stay out of the market. I think any kind of market volatility, any kind of sharp pullback in the next 90 days could be an opportunity to accumulate slowly. I think there's no reason for investors to wait for the full 90 days to act, but I think it's possible that even if the tariffs turn out to be higher than expected, they may eventually be negotiated lower, especially if the tariffs hurt the U.S. economy. Then Trump may be open to further reductions in tariff rates. So you don't want everything to play out blue skies before you buy into markets. You want to basically in some ways face your investments into the markets.
Well, then, should investors still be investing in the market at all, Vasu? I mean, should they pull out from markets, or is staying in cash a mistake in the current market? Under what conditions might holding cash be more justified?
Well, if we have doomsday, we have a deep recession in the U.S., all-out trade war between the U.S., China, and all of U.S.'s trading partners, yes, then, maybe you hold cash, right? But otherwise, I think there's no strong basis to hold cash right now because we're not seeing such a situation. We're seeing a pullback in the market. It's a healthy pullback. It's not a crash. It's not a catastrophe. And I think it won't be a mistake to, stay completely in cash in this market. The best strategy is to face your investments in and not pull out of the markets. If you've got money in the markets, you might want to rebalance a little bit, especially if your equity positions have gone up a lot. But otherwise, staying out is definitely not something we're recommending. In fact, we are saying that the volatility can actually throw up opportunities.
Well, speaking of best strategy here, Vasu, dollar cost averaging has been a proven strategy in volatile markets. Is this the preferable method in a volatile environment like today's?
Without a doubt. I mean, this is an excellent strategy in a market like that. Some people call it dollar cost averaging. Some people call it phasing your investments in the markets, regular investment plan, there are different names for it. But essentially the objective is you've got a certain sum of money. You want to spread it out over perhaps the next 3 months, 6 months, 9 months into the market so that you have dry powder should the markets pull back to buy even more. Now, this is a strategy where you time diversify. We're all very familiar with the concept of diversification in terms of asset class. Now, we don't hear enough being talked about time diversification, and this is essentially time diversification and another risk management strategy allowing you to invest in the markets without taking excessive risk.
Well, Trump has also promised more sectoral tariffs, with pharmaceuticals being next in line, and this poses an additional uncertainty for markets. So, Vasu, with the possibility of, sector-specific tariffs like those on pharmaceuticals, how should investors approach sector allocation?
Well, investors should be very careful with the sectors that Trump has highlighted, essentially the semiconductor sector. As you mentioned, the pharmaceutical sector, he's talked about copper, he's talked about lumber. This is some of the sectors that he's mentioned. So investors ought to be a bit more careful because we're not clear as to what exactly the tariffs are that he's going to impose on these sectors. What's interesting is that he imposed 25% tariffs on the auto sector, but now he's talking about pausing the tariffs because, he says U.S. auto companies need time to build up their domestic production capability. Right. So similarly, Trump's tariffs on these sectors he talked about are not a fixture. They could change. You don't want to be too negative on these sectors, but at the same time, because he's highlighted them, you want to be a bit more careful with these sectors.
Right. Well, taking a look at regional markets as well, Vasu, how do you view investing in the Chinese market? Are there any opportunities there, given that, trade tensions are rising between China and the U.S.?
We think there are. In fact, one of our top conviction calls is Chinese equities.
Okay.
Yeah, because if you look at the valuations for Chinese equity markets, they are very low right now. They're almost one standard deviation below the 10-year historical average. So a lot of negativity has been baked in to the Chinese equity markets. But at the same time, going forward, China has the capacity to boost the economy and the markets through stimulus. So we think that China is something that investors want to keep an eye on. The Chinese government has been meeting in the last couple of weeks to discuss about stimulus measures in terms of domestic consumption, the housing sector, technological innovation. And where we see opportunities in China would be 3 areas. Number one, quality stocks that offer you good yield. And this would be sectors like telecommunication, utilities, state-owned banks. We also like, secondly, the internet platform companies in China because, basically they are proxies to the acceleration and broadening of China's AI adoption. And third, we are looking out for companies that will benefit from the domestic consumption and technological innovation boost that China is talking about. And there are quite a number of companies in this space as well. So there are enough opportunities in China. But with Chinese market, you need to have patience and you need to be able to, you must have a strong risk appetite because the market can be very volatile.
Besides China, Vasu, then what other regions or markets are offering value or attractive risk-reward profiles?
Well, we like the Asia ex-Japan region generally. I mean, within Asia ex-Japan, I've highlighted China, but one other market that we like is Singapore. Okay. We think the Singapore market is an interesting market. It's a defensive market. Companies here have got pretty good corporate governance. They offer you pretty good yield. You can find many blue chips here that give you yield. And the Singapore government has got a very strong balance sheet. If we go through any kind of slowdown or recession, they'll be able to use that balance sheet to help the economy. But more than that, you have quite a number of companies here that offer you pretty attractive yield. And so we think the Singapore stock market is something else that, investors should keep in mind. Bearing in mind also that, the authorities, the government, is trying to revive the stock market through various measures. It won't be something that happens overnight, but it could play out in the coming months and maybe in years. So do have some allocation in Singapore equities.
Interesting. Well, Vasu, overall, with investor sentiment being so fluid, what key indicators or developments should we watch to better gauge market direction in the coming weeks?
Well, tariffs, Trump have been the key focus of the markets, and I think it will remain the key focus of the markets. But I think the other thing that the markets worry about, aside from tariffs, is the risk of a recession, the risk of inflation. Now, the data in the coming weeks and months will be something the markets will watch out for, because this will be real-life data that gives you the actual picture of the economy and how the economy is responding to tariffs, whatever has been imposed right now, how the economies around the world are responding to it, how inflation in these economies are responding to it. And I think the current earnings season is also an important one, because as it takes off, I think a lot of analysts will be going through the comments from CEOs and management of the companies to see what they think about the outlook of their business, because that will also determine how their stock prices perform.
And finally, before we let you go here, Vasu, what scenarios do you envision if trade negotiations over the next 90 days break down or stall? How could that impact global markets?
Well, if they break down or they stall and Trump actually goes back to the tariff rates he talked about on the 2nd of April, which were relatively draconian, then I think the markets will be very spooked and you could see a sell-off, right? But on the other hand, based on what I've seen so far, it doesn't look like he got the tendency to head that direction. It's not something he wants to do. He's seen what happened to the U.S. bond market with his moves, and I think Trump is very worried about the U.S. bond markets and how tariffs. So even if it breaks down, it stalls, they could open up a new chapter, and we could see another attempt at trying to find a negotiated settlement.
All right. Well, thank you so much, Vasu, for joining me today.
Thank you for having me on the show as well.
Thank you. That was Vasu Menon, Managing Director of Investment Strategy at OCBC. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.